In 2005, a man no one had heard of walked into a room full of Wall Street gods and told them the American dream was about to detonate. They laughed. 1 year later, they stopped laughing. 3 years after that, the global economy lay in ruins, and this same man had turned $100 million into $700 million by betting against every assumption civilization was built on. But here's what no one tells you. He didn't just predict the crash, he predicted the recovery. He predicted the next crash after that, and the one after that. While the world rebuilds, he waits, watching, calculating the exact moment it happens again. The question isn't whether he's right. The question is, how does one mind see what billions cannot? To understand prophecy, you must first understand blindness. In 2008, when Lehman Brothers dissolved into history's largest bankruptcy, the world asked how. How did the smartest minds in finance miss what was obvious in hindsight? The answer is uncomfortable. They didn't miss it, they refused to see it. Michael Burry, medical doctor, metalhead, Asperger syndrome, obsessive reader of financial statements in the dead of night, saw it because he had no choice. His brain couldn't filter out the noise that everyone else called consensus. While Goldman Sachs traders measured risk in models built by Nobel laureates, Burry measured it in something older, something human. Greed, fraud, the mathematical certainty that lies compound until they collapse under their own weight. He didn't use complex algorithms. He read mortgage documents, thousands of them. While his investors threatened to sue him for sitting in cash, he found the rot at the foundation of American housing, the loans given to people with no income, no jobs, no assets, packaged as AAA securities and sold to pension funds holding teachers' retirements. The subprime mortgage. 3 words that would destroy $10 trillion in global wealth. But Burry saw something else, too. Something that disturbed him even more than the coming collapse. He saw that no one wanted to know. Before he was the man who broke the housing market, he was just Michael. Born in 1971, lost his left eye to cancer at age 2, grew up knowing that bodies fail, that systems betray, that the surface rarely matches the structure beneath. Medical school seemed logical, the human body as machine, symptoms as data, diagnosis as pattern recognition. But medicine had a ceiling. You could save 1 patient, maybe 10. The numbers were too small for a mind that processed reality in spreadsheets and probability trees. He discovered value investing by accident. Benjamin Graham's The Intelligent Investor, the same book that shaped Warren Buffett, found him in a library stack. The concept was simple, almost insulting in its clarity. Buy things for less than they're worth, wait, repeat. Burry started writing, not for money, for clarity. His blog in the early 2000s attracted a cult following, analysts, hedge fund managers, people who recognized that this unknown doctor in California was seeing patterns they couldn't articulate. By 2000, he had quit medicine. By 2005, he managed $600 million. By 2007, he had placed the largest bet against the housing market in financial history, without permission from most of his investors. They called him crazy, paranoid. They tried to pull their money. They threatened lawsuits. He locked their capital, refused redemption, sat in his office in Cupertino, California, listening to heavy metal, watching the numbers turn red while the world stayed green. Then, the turn. August 2007, the first subprime lenders failed. By March 2008, Bear Stearns collapsed. By September, Lehman. Burry's fund returned 489%, and he closed it. Here's what the movies got wrong. The Big Short made Burry famous. Christian Bale played him as eccentric, obsessive, socially awkward, but ultimately vindicated, the hero who saw the truth. The reality is more complex. After 2008, Burry didn't celebrate. He studied. He watched the Federal Reserve inject trillions into the system. He watched interest rates drop to zero. He watched the same banks that caused the crisis grow larger, more concentrated, more systemically dangerous than before. And he started seeing the next one. In 2019, he warned of an index fund bubble. Passive investing, he argued, had created a distortion where money flowed not to value, but to size. The biggest companies got bigger simply because they were big, not because they were good. In early 2020, before COVID-19 had a name, he positioned for pandemic. Not because he predicted the virus, no one did, but because he saw the fragility, the leverage, the just-in-time supply chain stretched to breaking. He made 1,500% on those trades. Then he saw something else. The response to COVID, $5 trillion in American stimulus, quantitative easing on a scale never attempted, direct cash payments while production stalled, created a different kind of bubble. Not housing, everything. Meme stocks, cryptocurrency, SPACs, NFTs, companies with no revenue trading at billion-dollar valuations because liquidity had to go somewhere. In 2021, he compared the market to the Dutch tulip mania of 1637. He warned of the greatest speculative bubble of all time in all things. He positioned for inflation when the Federal Reserve insisted it was transitory. By 2022, inflation hit 9.1%, a 40-year high. But here's the pattern that matters. Not that he was right. Everyone's right sometimes. It's that he was right when being right was impossible. How? Not mysticism, not luck. Burry's method is almost insultingly available to anyone willing to do the work. First, primary sources. While analysts read analyst reports, Burry reads 10-Ks, the annual financial reports companies file with the SEC. Hundreds of them, thousands. He doesn't trust summaries. He wants the raw data, the footnotes, the accounting assumptions buried on page 247. Second, historical pattern recognition. The 2008 crisis wasn't unique. It rhymed with the savings and loan crisis of the 1980s, with the dot-com bubble, with the South Sea bubble of 1720. Human nature doesn't change, only the costumes. Third, inverse thinking. When everyone believes something, Burry assumes the opposite and tests it. If housing never goes down nationally, a consensus so strong it was built into risk models, what would it take for it to go down? Then he finds the mechanism. Fourth, patience as weapon. Most investors can't endure being wrong for 6 months. Burry endures being wrong for 3 years, knowing that mathematics doesn't care about his timeline. Gravity wins eventually. But there's a fifth element, the one that separates analysts from prophets: moral imagination. Burry doesn't just see numbers, he sees incentives. He asks, what would I do if I were a mortgage broker paid on volume, not quality? If I were a ratings agency paid by the issuers I rate? If I were a CEO whose compensation depended on quarterly earnings? He follows the incentives to their logical conclusion. Then he bets that conclusion arrives. As of 2024, Burry has positioned again. His fund, Scion Asset Management, has bet against the S&P 500, against semiconductor stocks, against the entire structure of the current market rally driven by artificial intelligence enthusiasm and concentrated in 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla, that now constitute 30% of the index's value. He sees what others call innovation and recognizes concentration risk. He sees what others call soft landing and recognizes delayed consequences. The Federal Reserve raised interest rates at the fastest pace in history. Commercial real estate faces $1.5 trillion in debt maturing by 2025. Regional banks hold that exposure. The Treasury has added $11 trillion in debt since 2020. Interest payments now exceed the defense budget. Burry isn't predicting catastrophe for its own sake. He's recognizing that systems under stress eventually break at their weakest point. The question isn't if, it's where and when. But here's what makes this different from 2008. In 2008, Burry was alone. Now he has company. Other investors see the same fragility, the same concentration, the same disconnect between asset prices and economic reality, which creates a paradox. If enough people predict the crash, does it prevent the crash, or does it change its nature, make it slower, stranger, more political? Burry's recent trades suggest he thinks the latter. He's not just betting on decline, he's buying gold, buying farmland, buying water rights, assets that exist outside the financial system entirely. The message is clear. The next crisis may not be a moment, it may be a transformation. We return to the opening question. How does one mind see what billions cannot? The uncomfortable answer: because billions choose not to. Human cognition is optimized for social coherence, not truth. We believe what others believe because believing alone is dangerous. Isolation, poverty, ridicule. The caveman who questioned the tribe's hunting strategy starved unless he was right, and right immediately. Burry's Asperger's, often framed as disability, may be adaptation. He processes social signals differently. The fear of standing alone doesn't register with the same intensity. The embarrassment of being wrong in public doesn't paralyze. He pays the price in other currencies: relationships, reputation, the simple comfort of shared reality. But he gains something rarer: clarity. In a world designed to obscure by complexity, by marketing, by the sheer noise of information, clarity is power. The power to act when others hesitate, to sell when others buy, to sit in cash for years while the market soars, knowing that mathematics is patient, but you must be more so. This is the hidden structure of financial prophecy. It's not about prediction, it's about preparation, about building the psychological architecture to endure the gap between seeing and being believed. Burry has endured that gap 3 times. He may be enduring it now. We began with a man in a room, telling gods they were mortal. We end with a different image, a man in a room, reading, always reading. While markets rise and fall, while presidents change, while technologies transform and transform again, lost investors. He has been called genius and crank, and both were true. But his real product isn't returns, it's a mirror. When Michael Burry bets against the market, he's betting against us, our optimism, our tendency to believe this time is different, our desperate need for narratives where things work out because we want them to. He wins when we lie to ourselves. Which raises the final question, not about him, but about you. If the system is designed to obscure its own fragility, and the people who see clearly are punished until they're vindicated, what does it cost to know the truth? And if you did know, if you saw the next collapse coming with the same certainty you see gravity, would you act on it? Or would you wait, hope, believe that this time the ground beneath your feet is finally solid? The oracle has spoken. The question is whether anyone listens before the speaking stops.